Picture this. You're scrolling through housing websites, looking at home prices that seem impossibly out of reach. Then suddenly, you see an advertisement promising to cut your monthly mortgage payments by hundreds of dollars. Sounds too good to be true, right? Well, that's exactly what the mortgage industry wants you to think about their latest so-called solution to the housing crisis, the 50-year mortgage. But here's what they're not telling you. What I'm about to reveal in this video will completely change how you think about home financing forever. The numbers I'm going to show you are so shocking that once you see them, you'll never look at mortgage advertisements the same way again. And trust me, the banks are counting on you not doing this math. In this video, I'm going to expose the dirty truth behind 50-year mortgages that the financial industry desperately hopes you'll never discover. I'll walk you through the real costs, the hidden traps, and the devastating long-term consequences that could literally cost you the price of an entire second house. But first, let me share something that will blow your mind about what's happening right now in America's housing market. The Trump administration is actively working on making 50-year mortgages a reality. Federal Housing Finance Agency Director Bill Polt has confirmed they're exploring these extended mortgage terms as a solution to housing affordability. But here's the thing they're not mentioning. There's currently a massive legal obstacle standing in their way. The qualified mortgage rule, which emerged after the 2008 financial crisis, specifically prohibits mortgage terms longer than 30 years. This isn't some minor regulatory detail. This rule exists because lawmakers learned the hard way what happens when financial institutions get too creative with mortgage products. You see, after the Great Financial Crisis, Congress passed the Dodd-Frank Wall Street Consumer Protection Act to make mortgage underwriting stricter. The qualified mortgage rule was specifically designed to prevent the kind of exotic loan products that contributed to the housing bubble and subsequent crash. Under current law, a 50-year mortgage is literally illegal as a qualified mortgage product. That means any lender wanting to offer such products would have to classify them as non-qualified mortgages, which typically come with higher interest rates and much stricter underwriting standards. But let's say the rules change and these mortgages become widely available. The monthly payment reduction might seem attractive at first glance. For a $300,000 loan, a 30-year fixed mortgage would cost you $1,529 monthly for principal and interest. A 50-year mortgage would drop that payment to $1,366. That's only $163 monthly savings. For a $400,000 loan at 5% interest, you'd pay $2,147 monthly with a 30-year term versus $1,816 with a 50-year term. We're talking about roughly $330 in monthly savings. Now, $300 might sound significant when you're struggling to qualify for a mortgage. But what the mortgage industry isn't advertising is the astronomical price you'll pay for those modest monthly savings. Are you ready for this? A $400,000 loan at 3.5% interest will cost you approximately $394,800 in total interest over 50 years. Compare that to $224,200 in interest over 30 years. That means you'll pay roughly $170,000 more in interest just for the privilege of those smaller monthly payments. But wait, it gets worse. Recent calculations with today's interest rates show even more devastating numbers. A $300,000 loan could rack up approximately $714,690 in interest over 50 years, compared to $347,515 over 30 years. That's an additional $367,000 in interest payments. Let me repeat that. You could literally buy another house with the extra interest you'll pay on a 50-year mortgage. The reason these numbers are so shocking comes down to basic mathematics that the mortgage industry hopes you won't calculate. When you extend your payment schedule by 20 additional years, you're paying interest on that outstanding principal for 2 entire extra decades. It's like compound interest working against you instead of for you. Every month, you're paying interest on money that would have already been paid off with a traditional 30-year mortgage. The current housing affordability crisis provides the perfect cover for these financial products to make a comeback. In California, the median price of a single-family home reached $904,210 as of May 2024. Meanwhile, the median household income sits at $91,551. To comfortably afford that median-priced home, a household would need to earn $239,000 annually. That's more than 2.5 times the actual median income. For families earning that median income of $91,000, a 30-year mortgage at 6% would require monthly payments exceeding $5,400. That would consume more than 70% of their entire monthly income. A 50-year mortgage might lower that payment to around $4,564. Still completely unaffordable for most families, but the marketing makes it sound like a solution. This is where the deception becomes crystal clear. The 50-year mortgage isn't actually making housing affordable. It's creating the illusion of affordability while trapping borrowers in decades of additional debt payments. Google searches for "help with mortgage" recently climbed to their highest levels since 2009. Adjustable rate mortgages are trending again. These are all warning signs that we're repeating the same mistakes that led to the last housing crisis. Industry analyst Logan Mottashami doesn't support the 50-year mortgage idea, stating that subsidizing more demand through extended mortgage terms isn't the policy direction America should take right now. His argument is that housing markets need to balance themselves through slower home price growth and increasing wages, not through financial engineering that masks the underlying affordability problem. The concern among experts is that easier financing terms could actually make the housing crisis worse by enabling buyers to bid up prices even further. When more people can qualify for larger loans, even with extended payment terms, it increases demand without increasing housing supply. Basic economics tells us this leads to higher prices, not better affordability. But here's what really should terrify you about 50-year mortgages. This isn't the first time they've appeared in American markets. In early 2006, during the housing bubble that led to the Great Recession, mortgage lenders in Southern California began offering 40-year and 50-year fixed-rate mortgages. The existence of these ultra-long mortgage products was itself evidence of a bubble in property prices and broader systemic instability. These extended mortgage terms appeared alongside other exotic loan products like no documentation loans, subprime mortgages, and ninja loans that required no income, no job, and no asset verification. We all know how that story ended. The 50-year mortgage was a symptom of market dysfunction, not a legitimate solution to housing challenges. Most mortgages before the Great Depression required 50% down payments and were interest only for 5 to 7 years, followed by a massive balloon payment. The 30-year mortgage only became standard in the post-World War II era, and for good reason. It aligns with typical career spans, allowing homeowners to pay off their mortgages right around retirement time. If you're finding value in this deep dive into the mortgage industry's latest scheme, make sure to hit that subscribe button. Your support keeps us going and allows us to continue exposing these financial traps that could cost you hundreds of thousands of dollars. We're just getting started with what the banks don't want you to know. Looking at other countries that have implemented these extended mortgage terms reveals some truly disturbing patterns that should make every American pause before celebrating this so-called innovation. Japan and the United Kingdom have both experimented with 40 and 50-year mortgages, and their experiences provide a chilling preview of what could happen here. Japan took this concept to an absolutely insane extreme during their real estate bubble. They introduced 100-year mortgages. Yes, you heard that correctly. 100 years. These were marketed as intergenerational mortgages that could be passed down from parents to children to grandchildren. The interest rates on these loans ranged from 8.9 to 9.9%, meaning buyers were paying nearly 1/10 of the property price every single year just in interest while building equity at a glacial pace. But here's the kicker. research studies concluded that these 100-year mortgages completely failed to make housing more affordable. Instead, wealthy homeowners used them as estate planning tools to reduce inheritance taxes. The extended payment schedules didn't help regular families buy homes. They just created more ways for the financial system to extract money from borrowers over longer periods. Spain and France offer mortgage terms up to 50 years, while Finland has experimented with 60-year products. But these longer-term mortgages have extremely low market penetration because most borrowers eventually realize the mathematical nightmare they represent. Switzerland and Japan still offer those 100-year intergenerational products, but they've become niche financial instruments rather than mainstream solutions. The current situation in Japan should serve as a massive warning sign for American policymakers and homebuyers. A growing number of elderly Japanese people are falling into poverty because they cannot pay off their mortgages with their pensions and savings. Many Japanese borrowers are not debt-free until age 73. Over the past 20 years, the average age at which home loans are expected to be fully paid off has risen by 5 years. Think about that for a moment. These borrowers are making mortgage payments well into their 70s. Workers' salaries often get cut in half when they reach retirement age, and pension benefits continue declining. The average retirement benefit for someone who worked 20 or more years was 17.88 million yen in 2018, which was more than 1.5 million yen, less than just 5 years earlier. Japan's mandatory retirement age is 70, which means retirees must dig into their limited pensions and savings to continue making mortgage payments. 15% of Japanese borrowers, aged 65 to 69, who used extended mortgage products in 2018, were working part-time jobs just to make their housing payments. These are seniors who should be enjoying retirement, instead forced to work because they're trapped in mortgage debt. This demographic shift illustrates exactly how extended mortgage terms can trap borrowers in decades-long debt cycles that extend far beyond their peak earning years. When your income drops by 50% in retirement, but your mortgage payment stays the same, you face an impossible financial equation. The extended mortgage that seemed like a solution in your 30s becomes a financial prison in your 70s. American families need to understand that this Japanese scenario isn't some distant possibility. It's the inevitable mathematical outcome of 50-year mortgage products. The numbers don't lie, and human lifespans don't change just because mortgage terms get longer. The political response to these 50-year mortgage proposals reveals just how controversial and potentially dangerous they really are. Representative Marjorie Taylor Greene has been one of the most vocal critics, warning that 50-year mortgages would reward the banks while leaving Americans in debt forever. Her criticism focuses on how these products would dramatically inflate interest payments rather than addressing the real causes of the housing affordability crisis. Greene has proposed alternative solutions that actually attack the root problems. She wants Congress to limit corporate ownership of single-family homes, which has been driving up prices in many markets. She's also pushing for legislation that would allow renters with strong payment histories to qualify more easily for traditional mortgages. Her bill to eliminate capital gains taxes on primary home sales would help seniors keep more of their home equity when they downsize. Financial experts across the board describe 50-year mortgages as nothing more than a band-aid solution. Even if homeowners theoretically have the option to refinance into shorter terms when interest rates drop, there's a massive problem called payment shock. When you refinance from a 50-year mortgage to a 30-year mortgage, you're removing 20 years from your amortization schedule. Even if interest rates have dropped, your monthly payments will jump dramatically because you're compressing the same loan balance into fewer payments. This payment shock issue reveals another layer of deception in 50-year mortgage marketing. The financial industry presents these products as flexible options that borrowers can easily modify later. But the reality is that most borrowers become trapped in the extended payment schedule because refinancing to shorter terms becomes financially impossible due to higher monthly payments. The historical pattern here should terrify anyone considering extended mortgage terms. Every time 50-year mortgages have appeared in American markets, they've been harbingers of financial crisis. They emerged in 2006 during the housing bubble, as lenders desperately searched for ways to keep the party going. They appeared alongside no documentation loans, interest-only payments, and adjustable rate mortgages with teaser rates. These weren't legitimate financial innovations designed to help families achieve home ownership. They were symptoms of a financial system that had completely lost touch with reality. The mortgage industry was creating increasingly exotic products to sustain an unsustainable bubble in housing prices. Before we dive into the international examples that will shock you even more, take a second to subscribe to our channel. We're one of the few places willing to expose these financial schemes that could cost you hundreds of thousands of dollars. The mortgage industry spends millions on marketing to convince you these products are innovations. We're here to show you the math they don't want you to see. The 30-year mortgage became the American standard for very specific reasons that had nothing to do with arbitrary tradition. It aligns almost perfectly with typical career spans and retirement planning. Most people buy their first homes in their 20s or 30s and want to be mortgage-free by retirement. A 30-year term makes this possible for borrowers who stay in their homes. But there's nothing magical about 30 years, and that's exactly the argument the mortgage industry uses to justify 50-year terms. They present it as simple math. Longer terms mean lower payments. What they don't advertise is that longer terms also mean you're paying interest for decades longer than necessary, dramatically increasing your total cost of home ownership while building equity at a snail's pace. The current push for 50-year mortgages comes at a time when housing affordability has reached crisis levels in most American markets. The average homebuyer now spends nearly 38% of their monthly income on mortgage payments, according to recent data. That's approaching the danger zone where housing costs consume too much of household budgets. But extending mortgage terms to 50 years doesn't solve this problem. It masks the problem while creating new ones. Borrowers get trapped in longer debt cycles, pay hundreds of thousands more in interest, and build equity so slowly that they may never achieve true home ownership security. The equity building problem with 50-year mortgages represents perhaps the most devastating aspect that mortgage salespeople will never explain to you up front. With a traditional 30-year mortgage, you start building meaningful equity within the first few years as your payments shift from mostly interest to more principal. But with a 50-year mortgage, you're essentially stuck in interest-only purgatory for decades. Let me break this down with numbers that will make your jaw drop. In the first 10 years of a $300,000 30-year mortgage at 5% interest, you'll pay down approximately $58,000 in principal. That's real equity you can tap into or benefit from when you sell. But with a 50-year mortgage on the same loan, you'll only pay down about $31,000 in principal over those same 10 years. That's $27,000 less in equity building, and we're just talking about the first decade. But this equity gap gets worse every single year. By year 15, the 30-year borrower has paid down over $100,000 in principal, while the 50-year borrower has barely cracked $60,000. You're literally throwing away decades of wealth building for the sake of a few $100s in monthly savings. But here's where it gets truly terrifying. If housing prices drop, which they inevitably do during economic downturns, 50-year mortgage borrowers become underwater faster and stay underwater longer than traditional mortgage holders. You've got less equity cushion to protect you, and you're building equity so slowly that you can't quickly recover when markets turn. Remember, we're not just talking about theory here. We've seen this movie before, and it doesn't end well. The mortgage industry has a long history of pushing products during affordability crises that seem helpful, but actually trap borrowers in worse financial positions. Interest-only loans seemed like great ideas until people realized they weren't building any equity at all. Adjustable rate mortgages with teaser rates looked attractive until the rates reset and payments doubled. If you're starting to see the pattern here, make sure you're subscribed to our channel because we're the ones willing to expose these financial traps before they destroy your wealth. Hit that notification bell too, because the financial industry doesn't want you hearing this information. The psychological trap of 50-year mortgages might be even more dangerous than the mathematical one. When you sign up for a 50-year mortgage, you're psychologically committing to being in debt for half a century. That changes how you think about money, risk, and financial planning. Instead of working toward the goal of being mortgage-free, you're accepting permanent debt as a normal part of life. This debt normalization has massive implications for how families plan for retirement, save for emergencies, and make other financial decisions. When your mortgage payment never goes away, you never experience the financial freedom that comes with owning your home outright. You're essentially becoming a permanent renter who happens to be responsible for maintenance and property taxes. The retirement planning implications alone should scare anyone considering these products. Traditional financial planning assumes your mortgage will be paid off by retirement, freeing up that monthly payment for other expenses or savings. But with a 50-year mortgage, you're looking at making housing payments throughout your retirement years, when your income typically drops significantly. Social Security and pension benefits are already under pressure. Medicare costs continue rising. The last thing retirees need is a mortgage payment that extends into their 70s or 80s. Yet that's exactly what 50-year mortgages guarantee for most borrowers. The marketing for these products focuses entirely on the monthly payment reduction while completely ignoring the lifetime cost increase. It's financial sleight of hand designed to distract you from the real numbers. They want you focused on cash flow today while ignoring wealth destruction tomorrow. Here's another angle the mortgage industry doesn't want you considering. What happens to your family if you die before paying off a 50-year mortgage? With a traditional 30-year loan, there's a reasonable chance you'll have it paid off, or nearly paid off, by the time you pass away. Your family inherits a valuable asset with minimal debt attached, but with a 50-year mortgage, you're likely passing significant debt to your heirs along with the property. Unless you carry substantial life insurance specifically to cover the mortgage balance, your family could inherit more debt than asset value, especially in the early decades of the loan. This intergenerational debt transfer is exactly what happened in Japan with their extended mortgage products. What was marketed as helping families achieve home ownership actually created multi-generational debt burdens that trapped entire family lines in mortgage payments. The opportunity cost of 50-year mortgages extends far beyond just the extra interest payments. Every dollar you spend on additional interest is a dollar that can't be invested in retirement accounts, your children's education, or other wealth-building opportunities. Over 50 years, those opportunity costs compound into truly staggering amounts. Consider this scenario. The extra $170,000 you'd pay in interest on a 50-year mortgage versus a 30-year mortgage could instead be invested in index funds, earning 7% annually. Over 20 years, that money would grow to approximately $660,000. You're not just losing the extra interest payment, you're losing all the wealth that money could have generated through proper investing. The financial services industry understands this math perfectly. They know that keeping you in debt longer means more profit for them and less wealth for you. The 50-year mortgage isn't designed to help you build wealth. It's designed to extract more wealth from you over a longer period. So there you have it. The 50-year mortgage isn't a solution to the housing crisis. It's a trap designed to keep you paying the banks for decades longer while building wealth at a snail's pace. Don't let smooth marketing fool you into trading hundreds of thousands of dollars for modest monthly savings. Your financial future depends on seeing through these schemes. Subscribe to our channel to stay ahead of the financial industry's next move, because we're the ones willing to show you the math they hope you'll never calculate.